AI-driven grace, where every innovation was seen as a catalyst for growth. But today, that narrative shifted violently. We are witnessing the birth of disruption anxiety. Investors are no longer looking at AI as a margin expander, but as a potential business model killer. The AI minefield isn't just a metaphor anymore, it's the new reality of the tape, where yesterday's winners are being re-examined for their vulnerability to being automated into irrelevance. When Cisco's numbers hit the wires, it wasn't just about a quarterly miss. It was a signal that the heavy spending on digital infrastructure is facing a moment of reckoning. The software sector felt a collective chill as capital began to exit en masse. This isn't just a rotation, it's a derating. The market is questioning whether the massive capital expenditure into AI will ever yield the promised returns, or if we are simply funding the obsolescence of the current leaders. The fear has moved beyond the server rooms and into the core of the service economy. From asset management to logistics, the human premium is being discounted. When a logistics giant like C.H. Robinson collapses by 14%, the market is pricing in a future where human coordination is replaced by autonomous efficiency. Even the financial titans are being viewed through this lens. Investors are weighing the risk that AI might dismantle the very wealth management moats that have stood for decades. Beneath the surface of equity volatility, the credit markets are beginning to tighten their grip. Big tech's insatiable hunger for AI investment is no longer seen as a sign of strength, but as a growing debt burden. We are seeing a subtle but significant stress in corporate spreads, as these giants tap the markets to fund their survival in the AI arms race. The cost of capital is creeping up, reminding everyone that the transition to an AI-driven economy is not a free lunch. In this environment of uncertainty, capital is seeking refuge in the mundane. The 1.6% slide in the S&P 500 masked a desperate rush into consumer staples and utilities. Names like Walmart and Coca-Cola have become the new safe harbors. Investors are fleeing the intangible promises of the future to embrace the boring reliability of the present. It's a classic defensive rotation, triggered by a sudden realization that the path to AI dominance is paved with more casualties than winners. As we look toward tomorrow's inflation data, the mood is one of déjà vu. The parallels to the early days of the internet are becoming impossible to ignore. We are moving from the discovery phase of a new technology into the disruption phase. This shift in sentiment from euphoria to fear suggests that the